Friend of the show, Jacob Silverman, author of the upcoming book Easy Money, Cryptocurrency, Casino Capitalism, and the Golden Age of Fraud. Jacob comes on to rip on these crypto grifters on occasion and more. Jacob, thanks for being here.
Oh, it's a pleasure. Thank you.
So, this has been an absolute saga, the collapse of FTX. You know, Miami Heat recently sold the naming rights to their arena. They're ripping off the letters because they're unable to pay for their sponsorship. And according to what I've read, it seems like Sam Bankman-Fried, the head of this cryptocurrency exchange, has lost billions of dollars in a matter of days, and it is in ruins financially. Although when you become rich, even if you go bankrupt, they always end up finding a way to get rich again or stay rich. But I guess let's just start at the beginning of this saga. Who is this guy, Sam Bankman-Fried, and how did he and FTX jump on the scene?
Sure. Well, Sam Bankman-Fried, or SBF as you sometimes hear him called, he started as a quantitative trader, a quant at Jane Street. He went to MIT. He is the son of a couple Stanford law professors. So he did pretty well as a early 20s trader at Jane Street. Then he went on from there to eventually found this big crypto empire that became FTX and Alameda were the two main companies. The first sort of origin story that you hear, at least, is that Sam found an arbitrage opportunity where basically he was buying crypto cheaper on American exchanges and selling it on Asian exchanges. It was called the kimchi discount. And some people even dispute that story, but allegedly that's how he made some millions to start. And then, that matured into a full-fledged crypto hedge fund called Alameda, and then FTX, which was an exchange, just like Coinbase or Binance or some of these other exchanges. Like a lot of these exchanges, Coinbase is in the U.S., but Binance and FTX were based overseas. There was a small U.S. version of FTX where you could trade stuff, but there were a lot more options and a lot more sort of leverage and risk offered on FTX global, you might call it. So that's where people really went to bet on the prices of cryptocurrencies. And that's what turned Sam into a billionaire, at least on paper. And, like most crypto empires, this was all built in just the last few years. And Sam became a major Democratic donor, as people seem to be well aware now. I think one thing we could talk about, or at least deserves pointing out, is that one of his right-hand guys, Ryan Salame, was basically an equal donor to the Republicans. So they really had both sides of the aisle covered. But I think in a lot of ways, Sam became sort of the safe bet for crypto. A lot of institutional investors liked him. Bill Clinton and Tony Blair would come to his conferences, whatever you think of those guys. But, like so-called mainstream serious people who may think that crypto is a little murky or dangerous, they thought that Sam was this sort of cherubic 30-year-old, he's 30 now, would be a safe bet and someone that they could trust. And, it has a lot of Theranos residences. I would say that, like Elizabeth Holmes, Sam was this young, kind of quirky, brainy guy who convinced a lot of rich people who didn't really understand his technology that he had the secret sauce. And that was kind of all that was needed. And off of that, he raised billions. And I mean, we can go into what went wrong, but that's really the origin of Sam. And he went down to the Bahamas and set up shop there. He had companies all over the world, but mostly he was living with a very tight group of people, friends from college and from his previous job at Jane Street. And they were running these companies into the ground, it turns out.
Yeah, I mean, so can you? One, I'm curious who's going to play him in the inevitable miniseries on it. But two, like, I am curious what distinguished FTX from those other exchanges like Coinbase, because from my reading of it, it's like, oh, okay, they make money on the fees from the transactions, but you're saying that that FTX allowed for riskier kind of bets and gambles on the prices of currency. So was that distinct from the other exchanges?
In some ways, Binance offers some pretty similar possibilities. There are other exchanges that are overseas, but in the U.S., for example, the main big regulated exchange is Coinbase, and there are much more limited options about what you can buy and sell there. It's mostly about buying and selling tokens. On these overseas exchanges, what you can do is you can buy derivatives and futures and bet against the price movement of crypto, which is super volatile. And the other thing they allow you is leverage. So basically borrowing free money sometimes up to 100x. And Binance used to do this too, though they cut down the amount of leverage. Actually, a lot of the industry did over a year ago, basically cut down the amount of leverage, the amount of free money you could borrow. So the issue here is when you're gambling on these overseas exchanges that have much looser rules about leverage, about what kinds of financial products they even offer, it's no longer just about buying and selling tokens. It's really about making these bets or making these complex trades that are almost akin to stuff on Wall Street. And when things go wrong, they go really wrong. And when you have leverage, you might double your money with just a little bit of price movement. But if the price moves just a little bit down, you're wiped out. So FTX became notorious as this sort of place where people could bet big, but a lot of people were also wiped out. And in general, across the industry, you have exchanges sometimes making monies off of trading fees, but it's kind of a mixed model. Some work with institutional investors, like Coinbase does a lot. A lot of the everyday traders have left Coinbase. They're kind of conflicting or overlapping business models. But in general, you want the most people on your platform. So if you provide FTX based out of the Bahamas, it's pretty loose in rules. You can be really aggressive if you want. That's a lot more appealing than FTX US, which is just, it's like playing in a much more regulated, tame casino with just a few games.
Yeah, it's like, to borrow like a sports betting metaphor. It's like, the U.S. based, I guess, trading companies only allow you to bet like straight up, and then you can do like 7-game parlays if you're trading with FTX or something like that.
Absolutely.
Yeah, and you can bet on like what color the Gatorade is going to be that gets dumped on the coach who wins the Super Bowl.
Yeah, all those prop bets. Yeah.
Right. Exactly. So now we're here. So this guy who's considered a boy wonder has basically lost everything, and there's $1 billion in people's just like customers' money that's gone. Plus, the Wall Street Journal, I guess, broke the story that he seems to have taken billions of dollars of customers' money and put it into that trading firm that you just talked about, Alameda. So, I mean, is that basically the gist of it?
Yeah. So Alameda made a lot of bad bets. Alameda was supposed to be separate from FTX, even if Sam owned a controlling share of both. But they were supposed to be separate. But it turned out they were nothing but they not only had offices together, and some of them lived together, the employees, there's been a lot made about how they all dated each other, but I don't really think that's that big a deal. Whatever. Or there's been a lot of stuff about how a lot of these people are on stimulants, which is, certainly an issue, but everyone in tech and finance is doing that. Mm-hmm. But more importantly, it's like, what do they do with the money? And so Alameda, which Sam owned, but put someone else in charge of, made all these bad bets, a lot of them in the DeFi ecosystem, decentralized finance. And when these other companies that started going under over the summer, like this Three Arrows Capital hedge fund, the Terra stablecoin, Celsius, FTX had a lot of exposure along the way. Alameda had a lot of exposure along the way. And so basically Alameda had a huge hole. What seems to have happened is Sam signed off on diverting up to $10 billion to Alameda to help cover their hole and really give them more money to gamble with. Now, Sam has admitted, probably not in his best interest, but he's admitted online to some wrongdoing. He has not acknowledged diverting the money, which is probably fraud. There's several types of fraud that might be in play here, but even wiring that money could be bank fraud. And there's also all kinds of questions about their banking, which extends somewhat into the U.S. So, there's a litany of possible crimes here, but the basic thing is, he owned all these companies. One of them lost a whole bunch of money, and he basically stole from his own customers, allegedly, to plug the hole. The thing also with a company like FTX is when people give you real money and buy crypto from you, you're supposed to just keep that real money. Mm-hmm. I think there's some things you can do with it, or perhaps some low risk ways you can manage it, but you're not supposed to go trade on it. And this is a fear actually throughout the industry, especially on the overseas exchanges, that they're gambling with customer money or diverting customer money towards other uses. We've seen this before, but this is probably the biggest scale that we've seen it. And now that it's in bankruptcy court, frankly, it's useful for the public because we're going to learn a lot. There was already a state filing today where you're starting to learn like how shambolic and horribly run this whole place was.
And yeah, and when you say supposed to, there's no regulations or guarantees to that effect, right? Like this is just kind of an honor system essentially that is in their terms of service, but he violated his own terms of service, and yes, it will be fraud, but like, you know, there's because of, you know, the inherently risky nature of it, that there is no guarantees, and this is that chicken's coming home to roost here.
Yeah, very much so. And even in the terms of service, you see some things that really put users, and I'm talking about like regular retail traders. I mean, there are people who lost a lot of money who can afford to. There are also a lot of companies that FTX invested in where they told the companies, hey, you have to put your crypto on our exchange. We'll hold on to it for you. Those companies are now out of luck. But there are a lot of everyday people, you know, who have lost money or can't get their money back, and they need that $500 or that $2,000. But there's not a lot you can necessarily do. Pardon me. Because there's so few guardrails with these exchanges, especially the ones based overseas. They make up the rules. A lot of them also, even though the US-based ones, they have clauses in their terms of service that when you give them your crypto, they're not necessarily just managing it for you. You're basically loaning it to them, or they own it. There can be real changes in the legal status of your crypto. Now, that may not sound like a big deal, but what happens when Celsius goes bankrupt or FTX goes bankrupt, you might then be in the back of the line of all the creditors as a regular retail trader because the legal status of your investment has changed. So I think we're going to see some of that too. You know, unfortunately, the moneyed parties and the VCs usually get paid out first. Sam says he wants to make retail investors whole, but I also want to make clear, like, the whole industry is set up like this, and it's set up so that when it falls apart, retail customers are the last to be made whole or to get anything in return. So
it's like they're at the bottom of, say, a pyramid. Like if you wanted to visualize it like that, right? You know,
very much so. Yeah, and in pyramid schemes, 99% of people lose their money, everything.
Yeah,
you know, and crypto, we've seen time and time again. The partisans of the industry can define it however they want, or claim it's for economic empowerment, or chart some utopian future. But what happens in practice is that the money gets funneled from information poor retail investors to VCs, people like Sam, and people at the top who are literally manipulating markets. Like, a lot of other crypto people in the industry hate Sam because they saw him as a market manipulator. He would, quote unquote, hunt their positions. But again, Sam was just a powerful operator among many who did a lot of these things, some of them which we can prove now, some of which I think we'll be able to prove later. So that also adds another wrinkle to this. This is sort of turned into a circular firing squad, or the thieves are all turning on each other. There's a lot of trash talking, a lot of people going after Sam, but that's why I also don't think this is over. More companies are going to fail. More people are going to be angry, more lawsuits. So it's going to be really messy. And frankly, of course, the everyday consumer is going to be hurt most.
Yeah, and I mean, what's so striking to me, and then I do want to get to the Singapore stuff. You have a little bit of time, right? If you wanted to get into that, like, what's so striking is how quickly this marketplace basically replicated the kind of crap that crashed the economy, right?
Yeah.
Which is just these banks that do not have enough guardrails or, like, you know, funds, and using their own customers' money to make risky bets to benefit themselves. And this was supposed to be a democratizing enterprise, and that's how it was branded. But in reality, it's just so quick to replicate all of the systems that crashed our economy in 2008 because of, like, again, just capitalism, but also lack of regulation, you know?
Very much so. And there's a computer scientist named Nicholas Weaver who's a big crypto critic, and he jokes that crypto is basically speed running like 500 or 1,000 years of financial history in the space of just a few years. And that's what we're seeing, you know? And now we're at the sort of subprime stage. Fortunately, this stuff has been mostly hived off from conventional banking. I mean, there's definitely some exposure. Companies will suffer, people will suffer, but it's kind of contained in a lot of ways. But what you're seeing is what we saw in a lot of ways in 2008. Complex products, complex financial products that no one understands, a lot of leverage, a lot of risk in the overall system that people haven't really recognized. And then this contagion, or that when some of this stuff starts falling apart or unwinding, all the other people who have invested or levered up along the way, then see their own positions start crumbling. So I think that's really what you see here, but of course with much less possibility for accountability or restitution. I mean, the sad thing is in 2008, we had so little accountability, and crypto kind of emerged out of that resentment towards Wall Street, a very justifiable one. But as I try to argue with some crypto folks, some of their diagnosis may be right, but the treatment or the alternative they've conceived takes a lot of the aspects of Wall Street and traditional finance and just makes them worse and more dangerous. And I think that's what we're seeing play out right now.
I mean, and that's why you see institutions like FTX take their operations abroad to an extent, right? I mean, not like we have great banking regulations here in the United States, but let's turn to Singapore's exposure here, honestly, because so they have a state-owned kind of investment outfit, and they invested like hundreds of millions of dollars into FTX. What is the fallout from that?
Well, you do have these major funds. Singapore's, which I believe is called Temasek. You have Sequoia Capital, which is a major VC firm, which also published this notoriously over-the-top article about Sam Bankman-Fried and then removed it, but you can still find it online places. They predicted that he was going to be the first trillionaire. So you can see just how these investors went a little nuts in putting, for whatever reason, putting Sam on this pedestal. I find it baffling. I don't know Sam well. I met him once. I've exchanged some messages with him. It's easy for me to say in hindsight, but I didn't see a genius. I thought he struggled to answer some important questions about his business and whether crypto was good for the world, but he had a nice story that people believed. I think what this most affects is sort of the next round of VC and big sovereign wealth fund financing for tech in general. Are we going to be able to do? People in crypto think, hey, this is just a bear market. We're going to come back to another bull run in 2 years. We're just going to spin this thing up again and find more use cases and increase adoption, and everything will be fine. I don't believe that, but they do because they've seen it before. I think this time's a little different. The bubble that's burst was much bigger. A lot of people are getting hurt. And then you have the sovereign wealth funds and the big VCs like the Singapore Fund or the Ontario Teachers Pension Fund, which contributed something like $200 million. And those kinds of big institutional investors, especially under a new regime of high interest rates, are not going to be pouring money back in to just run this back again. They're going to say, like, look what you did to us last time. Now, if for some reason Sam or his cohort has a new story to tell about crypto a year or two from now, maybe that money will come back into the system. But I really doubt it. And I think it might be for the best to kind of let this run its course and then establish some regulatory regime that actually protects people in the future.
But like the like for a country like Singapore specifically, like is there even an understanding of how that's going to trickle down or affect people in the country? Just because, will it?
Singapore has a big crypto ecosystem. It was a center of the 2017-2018 ICO boom, and they are an authoritarian state, basically a quote unquote benevolent dictatorship. I don't think that they will suffer kind of scams in their midst. The 3AC Capital guys used to be in Singapore. When their hedge fund went under, they left, and I think it was quite deliberate. So I think what you might see in a place like Singapore is, one, they'll be more careful with their outside investments. I don't think there'll be much economic fallout at home, but you could easily see them cracking down on sort of the domestic crypto industry, trying to regulate it more. Because, for example, when the 3AC guys went down, it's a little embarrassing for a country like that to have those guys just being at the heart of your fintech ecosystem. So I think you'll find other countries like Singapore kind of readjusting their regulatory regimes. FTX was involved all over the world. Binance has footholds all over the Middle East and even in France and parts of Africa. And perhaps, if we're lucky, some of these countries will say, are we giving too much over to these companies? Even too much sovereignty over our financial system? I think that's a real issue that some of these countries might start examining too.
I just have like deep concerns for even a country like, of course, a country like El Salvador, right? Where they have this, crypto enthusiast as the president, and the fallout from that. It's gonna be terrifying.
Yeah, they have major problems politically, economically, huge debt. China recently offered to buy all of El Salvador's debt, which is basically like, do you want to become a colony of China?
Yeah.
And I think they said no. Bukele, who's ever the showman, says he's now going to buy 1 Bitcoin per day. But, they have a very small GDP there, about $25 billion a year. A quarter of it comes via remittances. Less than 2% of that is through Bitcoin. Like, people just don't like it there. We've been there and talked to folks there. But it's a very troubling situation when you have, like, for example, El Salvador basically announced that they were going to let Bitfinex, which is associated with Tether, a major crypto company, write their digital securities laws. And I think that's what you see happening all over the world, either formally or informally. These companies are rewriting financial rules all over the world, whether they're crypto exchanges or stablecoin companies or just or some influential lobbying groups. It's happening here in some ways. It's happening very obviously in El Salvador and in other places. I mean, even Kazakhstan has all these crypto companies setting up shop there now. And it's not about democratizing the economy. It's about making money and also perhaps undermining a little bit of the local financial sovereignty of that government there.
It's also it's shock doctrine politics in the sense that
Yeah.
right, like, Naomi Klein's book, it's these are more like unstable systems that are more easily exploited, especially if you're coming in flashy with like a bunch of Bitcoin or crypto wealth generally. So,
Mm-hmm.
anyway, I really appreciate your time today, Jacob. Thank you so much for coming on. And when's easy money, cryptocurrency, casino capitalism, and the golden age of fraud coming out? Because I feel like you're gonna need 40 addendums by the time that it's published.
It's scheduled for July 2023. We're turning in the draft next month, but we're sort of writing to the headlines in some ways, but also trying to look towards the future and make sure this is a book that'll have a little bit of a shelf life. And we'll be writing other articles and doing other stuff then, so I'm not going away.
All right, awesome. Well, check out Jacob's work. I really appreciate your time today. Thanks so much.
Thanks, it was great.
Yeah.